Scott. Thanks so much for allowing me to be part of the podcast.
Most people speak on their throat.
I think you'd be a superstar in the banking industry.
We have not seen any dead bodies in the dumpster.
Tell us one of the dumbest, stupidest things you've ever done in your business career.
You have entered the world of accounting, the place where business dreams and financial reality collide into exciting things like journal entries, debits and credits, and financial statements. Everyday CPA Podcasts, helping you and your business better compete, succeed, and win.
This is part 2 of a 3-part series.
Greetings, this is Kelly Coughlin, CPA and CEO of Everyday CPA, providing tax, accounting, and revenue solutions to individuals and businesses throughout the U.S. In today's podcast, I'm going to interview a former grizzly bear. Yep, in a former life, for 30 years, he was a grizzly bear who took the shape of an IRS officer, seizing assets and pursuing DOJ tax lien foreclosures. David Ronquillo began his career as a revenue officer in 1980 in Seattle. He's held positions as field collection group manager and senior collection policy analyst. Currently, he's helping tax professionals increase their knowledge and skills representing clients who are dealing with the IRS collection operations. David, I want to welcome you to the Everyday CPA podcast and want to first ask you, what about access to retirement assets? Is that fairly standard operating procedure? Look for retirement assets, grab those, customer pays, taxpayer pays, income tax, and a penalty on that, or are they exempt from the penalty?
Levying retirement accounts is one of the last things the IRS wants to do. They will do it in what they call egregious cases. That's where you have a taxpayer that just really isn't cooperating. The Internal Revenue Manual gives some examples of how they define egregious. You know, one of the other things is that they continue to make contributions to their retirement account. The big thing about retirement accounts is whether the taxpayer has access to it or not. So, for example, if the taxpayer can take the money out of the retirement account, IRS can levy. If they can borrow against it, IRS can levy. But in some situations where the taxpayer cannot do anything with that retirement account, you know, the way the plan is set up, they have no access. They basically have no interest in that retirement plan. The IRS cannot get it. To get a retirement account, an IRA, for example, that has to go up through 3 levels of management for approval. There has to be a good reason why the revenue officer wants to levy it, and only revenue officers can levy retirement accounts. The automated collection system, the telephone call site cannot. Has to come out to a revenue officer. So they have to justify, you know, write up a memo justifying why they want to levy the retirement account. They send that up the management chain up to the area director who, if everybody agrees, they sign off on it. And then the levy is served on the retirement plan. So it's a lot of work that the revenue officer has to go through. It's a end of the line procedure to do. The revenue officer knows that his or her stuff is going to get reviewed, and so they have to have a good justification as to why they want to do it. So it doesn't happen very often, but yes, it can happen. So and it comes down to the amount of cooperation that the taxpayer gives with the revenue officer. But IRS changes procedures last summer, where now a taxpayer can ask the IRS to levy their retirement account. I've had 2 clients that have wanted that done, because what it does, it avoids that 10% early withdrawal penalty. But it's a matter of convincing the revenue officer to do it. In these particular cases, the individuals had like $200,000 in their retirement account that would full pay the tax. So it's a matter of going to the revenue officer, basically making the case for them to do the levy. They run it up the line, levy, tax gets paid.
Why are they so hesitant to want to go after retirement assets? For the obvious reason they want to put retirement in jeopardy?
Yeah, exactly. the National Taxpayer Advocate has made a big issue over it, IRS going after retirement accounts, because of it jeopardizing an individual's retirement. That's basically it. So in fact, she is somewhat opposed to the fact that a taxpayer can go in and ask the IRS to levy. I read in the last report, or maybe his last 2 years reports, where they were hesitant to do that. But, like I say, these two clients that I had, that's what they wanted. That's how they saw getting rid of their tax liability. And they had the ability to make a lot of money, so they weren't that concerned about them taking the money.
Okay. Will the IRS force taxpayer to sell their home to recover tax liability?
They may. It depends. The first thing you have to look at on a residence, personal residence, how much equity is in there. For IRS to seize an asset, generally what they do is take 60% of the fair market value, and then they look at any encumbrance against it. So, for example, with a home, let's say, for example, it's worth $100,000. They'd start with 60% of that, which would be $60,000. Then the next question is, how much is the mortgage against it? And if the mortgage is more than 60%, in this case more than $60,000, there's no equity for the IRS to seize. But if it's less, let's say, for example, the mortgage was $20,000, you got a $40,000 difference there between, the $60,000 and the $20,000. Then they would look at it. What they would do is ask the taxpayer to go borrow against the equity, go refinance the house. And sometimes the revenue officer may ask for the taxpayer to attempt to borrow from 3 different lending sources to get, if they're not approved, at least get the denial letters, the loan denial letters, okay? In those instances, if they're not approved for a loan, the revenue officer may decide, well, they're not approved, we're not going to take the house, and we're just going to let it go and put them on a payment agreement. In other cases, the revenue officer may decide, no, there's enough sufficient equity in there, so we're going to go after the home. If they decide to pursue seizure of the residence, again, they have to go all the way up to the area director, 3 levels of management to get approval. Then the case goes over to the Department of Justice, Civil Tax Division, who then takes the case before a federal district court judge to get approval. So residential seizures have to be approved by a federal district court judge. Once they get the approval, then they can go in and seize the residence and put it up for sale.
Easier for the IRS to get retirement assets or to get personal residence, generally speaking?
Retirement assets.
Are easier?
Definitely, they're easier. They're easier to get.
Okay.
So it comes down to how egregious the case is. How much equity are they looking at? What kind of cooperation are they getting from the taxpayer? So,
when you say egregious, are you talking about the liability, size of the liability, or the reason for the liability? Civil fraud, that sort of thing.
It's the reason for the liability and the level of cooperation that they're getting from the taxpayer. Okay. We've had taxpayers that, they don't cooperate at all. They wouldn't contact us. You get in touch with them. They're argumentative. They're not going to do what you ask them to do. And you could be in a situation, well, really the only thing you can get is their personal residence, and there's sufficient equity in there that's going to make, a significant dent in how much they owe. And you look at the background as, well, how did they run up the tax? It could be a trust fund recovery penalty where they had a company that, they ran up, $1 million of trust, in employment tax. So
yeah, right.
All of the factors that IRS has to take into consideration.
Okay. How much of the individual IRS representative personality influences the outcome and direction of a case? Or another way of putting it, if you're not getting along well with this particular agent, can you get a different one assigned to it?
Simple answer is no. It would have to be some facts and circumstances of how the interaction is going between the taxpayer and, let's say, the revenue officer for IRS management to move the case. Simply disagreeing with a decision that the revenue officer made is not going to move it. The revenue officer would have to be doing something where they're violating, policies or procedures, or maybe harassing the taxpayer, or just really totally out of bounds with the taxpayer. The taxpayer can go to the group manager, and ideally they would have documentation to that effect, maybe quotes of what the revenue officer said to them, maybe what they proposed to the revenue officer to resolve the case and why the revenue officer is rejecting it. That type of instance, the manager would consider, maybe we should move the case.
Okay.
But generally, it's very, very, very difficult.
Give us some background on how and where cases are assigned.
IRS has different stages. When a tax return is filed and there's tax due on the case, it goes through what's called the notice stream, where this is on income tax, for example. 4 notices will be sent out to the taxpayer.
What notices are you? Form, F-O-R-M?
No, 4, F-O-U-R.
Okay.
4 notices. And generally the notices get a little bit stronger as they go down the line. They generally come out 4 to 6 weeks apart, but I've seen instances where a taxpayer will get a second notice and then never get a third notice or never get a fourth notice. The third notice, it's called a CP 504. If you look up in the upper right-hand corner of the letter, it'll say CP 504, and it'll say intent to levy. And the paragraph will state that the IRS can levy basically on state income tax refund. So in states that don't have income tax, really the notice is meaningless. Nothing can be done. So for example, here in Texas, we don't have state income tax. When our clients get that notice, we just know, well, we're probably going to get the final notice here another, 4 to 6 weeks from now. But basically, we can ignore that notice. In California, for example, with the state income tax, the IRS can levy the state refund if the taxpayer is due one. The final notice, it can be what they call an LT11 that comes out of ACS, or it can be an L1058, which comes from the revenue officer. It'll state on it in big bold letters, final notice of intent to levy. The taxpayer has appeal rights with that. They can file what's called a collection due process request within 30 days of that notice, which will stop all enforcement. The IRS cannot levy unless it's a jeopardy situation, and those are rare. So what happens with filing the notice is you're requesting a hearing with the appeals division, and in the meantime, you can get your financial statement together, a case resolution proposed, and you're supposed to be able to work still with the revenue officer, but what we've seen is a lot of revenue officers will just take that and send that up to appeals. If there is no response, and we're talking about going back through the notice stream where an RO does not have the case, if the case is large enough in dollar-wise, and generally it's $100,000 or more, it may be assigned out to the field, to a field collection group, to a revenue officers group, okay? IRS has algorithms where they score cases. They classify a case as high risk or medium risk or low risk, and they look at the probability of collecting what is owed. Their algorithms can figure this out. The case is scored, it is sent out to a revenue officer group. When it gets into a revenue officer group, it goes into what's called a queue, like a holding file. So as revenue officers need cases because their inventory is limited to a certain number of cases that they can work, if they need cases, the group manager will pull the case out of the queue and assign it to the revenue officer to work. That's basically how the cases are assigned from the very beginning, from the time where the return is filed, all the way get out to a revenue officer. There's permutations in between, different things can happen, but generally that's the way it works.
So you said they're scored. Give us some idea on the algorithm, if you will, some of the calculus that goes into that. Does it get a high score if there are assets to be recovered and it's more likely to recover those things, and then those get elevated and accelerated and get the attention, And then if it gets a low score, does it go down the path of currently not collectible, that kind of thing? Is that how that works?
Yeah. Say, for example, we have an individual that earns $200,000 a year in W-2 income or even 1099 income. The IRS knows about that. Say, for example, they have mortgage interest on their tax return. The IRS knows about that. So based on what's on the tax return and other data that the IRS can pull, they will look at that type of data and generate a score, probably in this case a high score, because there's a source of income and they have assets. So conversely, if you have an individual that, let's say they make, $30,000 a year, and that's all they got, they file a 1040-EZ. They may owe tax, they may have accumulated tax over a number of years, but if you're choosing between who you're going to go after to collect, you go after the individual that's making $200,000 a year versus the one making $30,000, where they can never get to the person that is making $30,000 a year. And they may owe, let's say they owe $100,000 that has accumulated over a number of years. That case will just simply sit in the IRS, the general IRS queue. The statutes will continue to run, and when the 10-year statute is over, the tax is wiped out. There's millions of dollars that are written off, every year because the IRS simply can't get to the case. It's not scored high enough, and they don't have the resources to get to it.
Yeah, that $30,000 income situation, would the IRS would most likely file a lien just in case there were some assets that appeared that they could then collect from that. Is that a fair statement?
Yeah, generally, I think it's a pretty safe statement. The filing the tax lien is automatically generated by the computer system. The threshold for filing a tax lien is like $10,000. You may have instances, I've seen them, where the tax lien is filed, but then nothing else happens. There's no further collection action. There's no levies. There's no other notices, but, the tax lien sits there. The notice of federal tax lien collects millions and millions of dollars every year without the IRS doing anything. Just file the tax lien, and then, a few years later after it's filed, the taxpayer goes to sell a piece of real estate, and boom, that tax lien is there. And the sale isn't going to go through unless that tax lien is dealt with.
Is there a statute of limitations on that lien?
No, it's 10 years.
10 years
from the date of 10 years from the date of assessment.
Yeah, right. Because it appears, you see on TV, a lot of these companies are out there, Optima Tax and others out there that are really aggressively pursuing this tax resolution business. I assume that they are targeting these tax liens that are filed. That's about the only public record of a federal tax lien, correct?
Yes. From what I understand, there are other companies out there that will generate lists you can get of people that have tax liens filed against them, that they can break it down by, county, city, zip code, state, and they can, they can break it down by dollar amount. And then these companies can buy these lists and then do their marketing to them, direct mailing, postcards, letters, things like that. So how effective that is, I don't know if it's that effective or not. We've had clients come in and say, yeah, I got all these letters from all these different tax resolution companies, how'd they get my name? I said, well, the tax lien filed against you. That's how they get it.
Thank you so much, Kelly, for having me. I really appreciate it.
Kelly, thank you very much.
Thank you, Kelly. We'll talk soon.
Thanks for tuning in to the Everyday CPA podcast. We will see you next time.